Hello, I'm Los Angeles City Controller Ron Galprin. As our city's Chief Financial Officer and watchdog, it's my job to help assure public dollars are being put to good use by keeping our government honest, responsive, and accountable. Because people want to know and deserve to know how their money is being spent. And just as it's important for the city to plan how to use our money wisely and make good investments, it's just as important for every Angelino to do the same. Because the financial health of our city, of our communities, depends on the financial health of every Angelino. Financial literacy and financial planning for individuals and families is crucial to success, and so is making positive financial choices for today and for the future, so that you can get bills paid, make the rent, save up for a car or a home, further your education and that of your loved ones, retire, plan for trips and vacations, and so much more. I want to thank so much our outstanding LA City Library and its leadership, including Chief Librarian John Szabo. Thank you to all the staff and the volunteers, notably our certified financial planners, and the library's Department of Lifelong Learning and its partners. And thank you for ensuring everyone has the tools and resources necessary to plan, save, invest, and manage their finances for the future, for their family's future, and for our city's future. To help with this, I would encourage you to check out my How to Build a Financial First Aid Kit tool, which gives you information you'll need to be prepared in case of an emergency. And you can find the kit at lacontroller.org/financial First Aid Kit. I wish you a positive and fruitful day of financial planning, and thank you all for participating.
Thank you, Mr. Galprin. Hi, everyone. I'm Caroline Zakarny, and I work for the Office of Civics and Community Services here at the Los Angeles Public Library. Welcome to Financial Planning Month. Today's presentation is called Investor Protection and is part of a month of programs in support of financial planning. This program is brought to you by the Securities and Exchange Commission, SEC, and the Los Angeles Public Library. Carol Lally from the SEC will talk to you about what the SEC does, how it can help you invest wisely, common scams, and tips to avoid fraud. Please send us your questions throughout the program because we're going to have a brief Q&A after the presentation. Thank you very much, and take it away, Carol.
Thank you. Thank you so much, Caroline. It's great to be here today. I've had the pleasure of presenting to Los Angeles Public Library audiences before, and really glad to be able to continue to do that on behalf of the SEC's Los Angeles Regional Office. So we're going to talk about investing in the digital age today. You should be able to see the PowerPoint presentation on the screen. And as was noted, I will take questions at the end if you want to put your questions in the comments as we go along. So before we get started with every presentation, I have to give a disclaimer, and that is basically that the statements that I make today are not a statement of official SEC policy, and I cannot provide business or legal advice. We're going to be talking about general principles of sound investing and sound financial planning for your future. We're going to do a brief overview of the SEC, so if you're not familiar with the agency, you can get a sense of what we do. We'll talk about some of the basics of credit and how to build wealth through saving and investing and the difference between saving and investing. And we're going to talk about some of the particular issues that modern technology raises for investing, both opportunities and things to be aware of, how to plan for your retirement, and finally some tips to avoid fraud. Just a little bit about my own background. I have worked at the Securities and Exchange Commission for just under 20 years. I'm an attorney. I spent about half my career in the Division of Enforcement, which I'll talk about a little bit in just a moment. And then the other half of my career I've spent managing the group in the Los Angeles office that conducts investor outreach like we're having here today, and that also takes in the tips and complaints of potential securities fraud and liaisons with other agencies. Pretty much everything that I talk about today is going to come from the website investor.gov, and you can see a mock-up of it there on the screen. If you go to it, I think you'll find it's really very user-friendly. It's designed for regular people like you and me, so there's not a lot of overly technical language on it, but it does also have a lot of really helpful in-depth information. And all of the colored bars that you see there on the screen contain drop-down menus with a lot of additional information. So let's talk about the SEC. For those of you who are not familiar with the U.S. Securities and Exchange Commission, this is the exclusive federal regulator of the United States securities market. And we have a three-part mission here at the SEC: protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation in the world's largest and most highly regarded securities market. As a part of that three-part mission, we have a number of responsibilities, basically enacting rules like other federal agencies do, reviewing disclosures of public companies, examining market participants like broker-dealers, and we do have, as I mentioned, a division of enforcement that is a civil, not a criminal enforcement agency that investigates and prosecutes violations of the federal securities law. It's an active group. As you can see, in fiscal year 2021, we had almost 700 enforcement actions, and we collected pretty close to $4 billion from the individuals and the entities that we prosecuted in our civil actions. The goal of the SEC, whenever possible, if these actions involve money that's been taken unfairly from investors, to try to put that back in the hands of harmed investors. And then not infrequently, we also work with criminal agencies when the misconduct rises to the level of potential criminal violations. Then federal criminal agencies and sometimes state criminal agencies get involved and may conduct their own parallel investigation and prosecution on the criminal side. We're a relatively small agency, small to mid-size agency, but the size of the market that we regulate is quite large. As you can see, there are tens of thousands of market participants that we regulate, and the size of the market is huge, in the trillions of dollars. There you can see on the screen that the size of the global capital markets for the most recent year for which we have data, roughly 2019, is $110 trillion. So quite large. So that's the basics of the SEC. We have 11 regional offices and a home office in DC, like many federal agencies. The Los Angeles office, which I'm a part of, covers all of Southern California, Arizona, Nevada, Hawaii, and the Pacific Islands. So with that out of the way about the SEC, let's talk about some of the basics of credit, because really an understanding of credit should come even before your investing plans. And some of this may be a refresher for a lot of you, should already know this. Many of you, you may be in the beginning of your investing and credit life, and so some of this may be new information for you. But even if it's a refresher, it's worth revisiting. As noted on the screen, the ideal credit relationship is one in which you establish some kind of credit history, because as you probably know, if you've tried to get a loan to buy a car or a house, having some kind of credit history is beneficial. So one way in which people frequently do this, at least as an initial step to creating a credit history, is by getting a credit card. The ideal credit relationship with a credit card or any other kind of debt is that you incur the debt, you use that credit card to make purchases, but then you pay off the debt on a timely basis. So with the example of a credit card, that would mean ideally paying it off each month. Then you establish a credit history that shows that you can manage debt successfully and safely, and you can improve your credit score. It's always important to take note of paying down high interest debt. So I use the example of a credit card. A credit card is typically very high interest debt, frequently sometimes around 18%. There is no sustained investment that you can make that on a sustained, reliable basis will return that kind of investment. So before you even get to your investing decisions, if you have high interest debt, it makes sense to focus on paying down that debt first, as opposed to engaging in taxable investing. Taxable investing would mean things like short-term trading, buying and selling of stocks. It probably makes sense to participate in some kind of tax-advantaged investing, meaning long-term investing, potentially in an employer's 401k plan, especially if the employer matches. But you really want to focus on paying down that high interest debt if you have gotten yourself into a situation in which you are carrying, for example, a balance on your credit card. Credit is expensive. So, for example, you can see the example on a slide. If you paid for a laptop in front $2,000. In 2022, a laptop might cost, that's going to cost you $2,000. But if you have to take out some kind of loan or line of credit to pay for the laptop, it's going to cost a lot more. So if you bought a laptop on credit and you paid only $50 a month, by the time you owned that laptop outright and you paid it all off 5 years later, that will have cost you $2,850. So $850 more than it would have cost if you could pay for it upfront without using credit. And by the time you get to the end of the 5 years, unfortunately, as we all know, the technology is probably becoming obsolete. So credit is expensive and should only be used when necessary or appropriate for the financially responsible decision to make. You can improve your credit score by paying your bills on time, not getting close to your credit limit, and only applying for the credit that you need. Check your credit report annually, make sure the information is correct, and as you know, and you probably know in California, we are entitled to one free credit report a year, so make sure you're getting that and make sure that you're checking it and making sure your credit score is accurate. Now that you've got your credit history in a good spot, let's talk about more substantive things that you can do towards planning for the long term, both saving and investing, and we'll talk about what the difference is between these two concepts. Saving is important for short-term challenges that you might face, whether they're emergencies or more short-term purchases. These might be family vacations, could be short-term financial educational goals. This is what a savings account is for. You want to make sure you have an emergency fund. Typically speaking, you want to try to save somewhere between 3 to 6 months of living expenses. And it's a good idea to try to set up automatic savings, such as if you have a regular paycheck that you use direct deposit for, it's a good idea to put some portion of that paycheck into a savings account, in addition to maybe having some portion of it in something like a checking account. Saving is usually placed in some kind of low-risk, frequently federally insured product, like a savings account that is federally insured by the government in a bank or a credit union, and it's usually used for these short-term goals. Because they're low risk, they are going to pay low interest. Investing is slightly different. Investing is planning for things that will happen much farther down the road in the future, like your retirement or maybe children's or grandchildren's college goals. That money is going to be put at risk for a greater period of time, potentially at a higher risk, with the idea that hopefully it will earn a greater return over time. Saving is money that you're less likely to be in a position to take that great of a risk. Investing, you might be in a position to take a greater amount of risk, particularly if the investing goal is far down the future. If you're just gotten out of college, you've just started a job, you're not planning to retire for many decades, you're in a position to take more risk with your money to plan for your ultimate retirement than you might be if you're closer to retirement. Why can't you just put all your money under the mattress or into savings? This is a version of the slide I've been presenting for many years about the unfortunate nature of inflation. And it's not a slide that I have to explain that much anymore, unfortunately. The answer is that inflation exists. Sometimes it's quite significant and it impacts the cost of goods. So if you just put your money under the mattress or even in a savings account, that interest rate is unlikely to keep up with inflation. So if you had put aside a money for a Ford Mustang convertible 25 years ago, and you plan on that Ford Mustang convertible costing you $24,000 25 years on down the line, you're going to be in for a rude awakening when you go to the dealer today and try to buy that same car. It's going to cost a significantly more amount of money. And that is why investing is an important component to planning for your financial future, not just saving. Saving and investing works through compound interest, and hopefully compound interest is a concept that you were introduced to at some point in your life. If not, I strongly encourage you to go to investor.gov and look at the most popular tool on that website, our compound interest calculator. Essentially, compound interest is the principle of earning an interest rate, not just on the money that you have invested or saved, but the interest that that investment or savings accrues. So over time, it's like snow being added to a snowball. You start with a small snowball, you roll that in the snowball gets bigger, and it requires more snow to cover the whole snowball. Maybe this is an analogy that's not as helpful here in Southern California. These slides are put together in DC. But if you've ever rolled a snowball, you understand that the snowball gets bigger because more and more snow is being added, not just to the original ball that you rolled, but the additional snow that you added onto it. The same way you might add to a ball of yarn. That's because that additional snow is like the interest on the interest. Stocks are an investment that are very popular with a lot of people. They pay interest by the share price potentially increasing over time, dividends that the company can pay out, bonds, another very popular form of investment. This is like a loan or an IOU that you invest by investing in a bond that essentially provides a loan to some government entity or a corporate entity and then pays interest periodically, usually twice a year, until the end of essentially the loan term when your principal is returned to you. And then funds can invest in a variety of securities, stocks, bonds, all different kinds of investments. It's like a pool of money invested in a number of different investments. And very often something like a mutual fund is something that is a smart investment for a lot of individual investors, particularly something like an index fund. The next slide attempts to illustrate, again with a graphic, the way in which compound interest works. So looking at this slide, we have a 25-year-old who's invested $48,000. That's represented by the green line. But as you can see, assuming a 7% annual rate of return, that $48,000 grows over time. $100 a month is the investment rate, and that growth is represented by the red line. Over the course of 40 years, that $48,000 that's come out of pocket of this individual investor is valued at over $200,000. And that greater value is attributed to the compound interest. It's not just the $48,000, it's the interest on that $48,000 and the interest on the interest that the $48,000 has accrued. Over time, your risk tolerance may change, and this is why investing for the long term is such an important concept. You can see on your screen the performance of the S&P 500, which is a very popular way of tracking the general stock market over the course of 30 years. And over the course of time, there are going to be ups and downs in the stock market. Generally speaking, over the life of the modern US stock market, there have been more ups than downs, but there are periods of downs. The farther out you are from your investment horizon, when you are going to need those funds, the more you are in a position to potentially take on more risk because you have time to make up for any down periods in time. Conversely, the closer you are to the end of your investing decision, the less you may be in a position to take on risk because you won't have as much time to recover any downturns in the market. Compounding, again, really drives home the power of starting early and how starting early really inures to your benefit. So if your goal was to, let's say, have an investment portfolio worth $250,000 by the age of 65, if you started investing on a regular basis at age 25 and each and every month put money into your investment account, you would only need to put in $104 a month, assuming a 7% average annual rate of return in order to end up at $250,000. But if you wait until you're very close to the end of your working career and you don't start investing for your retirement until you're 55, you're going to have to put in a lot more money to reach that $250,000 goal, upwards of $1,500 a month, assuming a 7% annual rate of return. And just by way of reference, a 7% annual rate of return is historically what the life of the US stock market, large cap, meaning large company stocks, have returned. So in any given year, the stock market might be up or down to a certain amount, but if you average it over the life of the stock market, somewhere around 7 to 8% is the average return. This is a figure that I like to point out, and I think it's a good figure to keep in mind because when my office takes in tips and complaints about potential fraud, very often what we see in these fraudulent schemes is they are pitching potential rates of return or even guaranteed rates of return, which is a red flag word. I'd be very cautious of investing in anything that uses that word, well outside of this range of 7 to 8%, 12%, 15%, 20%. When you start having an investment pitched to you with that rate of return, your antenna should go up and you should want to do a lot of digging, because it is really very hard to beat the average rate of return of the stock market over time. And something with that high of a rate of return sustained over any long period of time is virtually unheard of. And so that's a big red flag of fraud. One of the best ways to make sure that you meet this goal of investing early and investing consistently is to automate both your saving and investing. Just like I talked about maybe having your paycheck direct deposited partly into a checking account and partly into a savings account, you can do the same thing with saving, with investing, particularly if you are fortunate enough to work at an employer that offers something like a 401k plan. But if you automatically direct some portion of your income every month, kind of set it and forget it to an investment account, it will take care of itself over time, building that account up, allowing you to earn returns on not just the money that you're putting in out of your paycheck, but on the interest that that account is accumulating. Keep in mind that all investments have risk. That's a nature of an investment. If somebody tells you this is a risk-free investment, again, your antenna should go up. That's a big red flag. Investments are not risk-free. That's the nature of risk. But there are steps that you can take to manage risk. First, you should kind of step back, take a look at your own financial situation and your goals, figure out what your own risk tolerance is. Are you able to take on a fair bit of risk? Are you a fairly conservative investor? And then once you know what your own goals are and what your own kind of perception is about how you should approach financial risk, then you can figure out how you want to manage the risk. And asset allocation and diversification are two tried and true ways to avoid putting all of your investment eggs in one basket. Just like anything else in life, you don't want to put all your investment assets into one particular kind of investment. And there are investments out there that meet all different categories of risk. So if you are at a very low risk place in your life, either because of your temperament or because you have a very short time horizon until you need those investment funds, maybe you're more interested in investment products that are lower risk, like CDs or money market accounts. But it can go up through the level of risk. Bonds tend to be more risky than those types of investments, but they have the potential, and the key word is potential, for higher returns. And then on into stocks, which are generally considered the riskiest category, meaning the potential to lose all your money, but have the potential for the highest returns. Risk and potential reward are correlated. So again, if somebody tells you this is a high return, let's say 15, 20% investment, but it's low risk, your antenna should go up. Those two things are correlated. Things with the potential for higher returns also have the potential for higher risk and greater loss. Asset allocation means dividing your investments into different categories. So, and I apologize, I said that the slides are prepared by DC. So you can see on the slide there's a pie graph and it says category names, and what they've meant to insert in there are stocks, bonds, and other asset classes. So asset allocation would be dividing your investment portfolio among these different categories, not having all your investments in stocks or all your investments in bonds, but divided among these categories. And knowing how you want to allocate that, what size of a piece of the pie you want to give to stocks or bonds, really depends a lot on your time horizon. Again, if your time horizon is pretty short, more than likely for most people, you want to be in a less risky, more of your investments allocated to a less risky investment class and fewer of your investment dollars allocated to the riskier investment classes. Conversely, if you have a long time horizon, you might be comfortable with, and it might make financial sense to give a bigger slice of the pie to the more risky investment categories. So for example, if you've got stocks and bonds in the red category, supposed to be other investments, within those categories, then you also want to do another kind of slicing of the pie. In addition to allocating your overall investment dollars between these categories, within each category, you want to diversify. And I apologize because on my screen I can actually see the category name. So within the stock category, you might, for example, invest in tech stocks. You might invest in railroad stocks, energy stocks, financial stocks. So imagine each one of these green slices of the pie is a different industry within the greater public company market. That's how you would diversify. Here's another way to look at diversification. This slide shows a snapshot of the S&P 500. So those are the 500 public companies whose stock is tracked by the Standard & Poor 500 index on a given day. So this day, I believe, is January 13th of this year. And each little square that you see represents the stock of one of those 500 companies. And the abbreviation is the stock ticker symbol. So you'll probably recognize right there in the middle at the top, GOOGL, that's Google. Next to it, FB, that's Facebook. If you look a little closer at this slide, you can see that these stocks are broken down into the industry categories that their companies, the corresponding companies' business is in. So for example, on the bottom right side of the screen, you'll see basic materials, and above that, utilities. In the top left side, you'll see technology. So by diversifying, if you were to invest, for example, in an index fund that tracked the S&P 500, rather than having to go out and research all of these different categories, you would automatically be diversified across these 500 companies by investing in an index fund that tracks their performance. And so you would be invested not just in the technology sector, but also in industrials, in healthcare, in real estate. And the benefit of this diversification is that if a stock is having a down day, like you can see on this particular day in the top left corner, technology was having a down day. Microsoft was down, Adobe was down, Apple underneath that in consumer electronics was down. Hopefully that's balanced out by the stocks having the up day. So immediately underneath that, the financial sector largely having a good day. Banks largely having a good day, as noted by green. That's the benefit of diversification, that if any particular sector is not performing well, hopefully that is balanced out by other sectors that are at least breaking even, if not doing well. As I alluded to, mutual funds and exchange-traded funds are a very popular type of investment for individual investors like you and me, and with good reason. These are essentially pools of money that an investment company invests in a lot of different investments, giving you that automatic diversification. The benefits of mutual funds or exchange-traded funds is that they are managed by professionals who have spent their careers figuring out how to invest wisely. They're usually affordable. It's usually much cheaper to invest in a mutual fund that tracks the S&P 500 than it would be to invest in each of those 500 stocks. If you engaged in the buying and selling of those 500 stocks, you would pay commissions and other fees related to each transaction of buying and selling those stocks. Those costs can be bundled in a mutual fund and therefore lowered in the same way you might think of, anytime you kind of bundle something, very often one of the benefits of that is it becomes more affordable. Mutual fund tends to be a lot more affordable way of investing in a wide range of stocks and bonds than buying them individually. Mutual funds do have risks, just like investing in an individual stock or bond, and those risks typically are the risks of the underlying securities held by those funds. So now that we've gotten this far and we've talked about mutual funds and individual stocks and bonds, you may be wondering, if I'm interested in investing in a mutual fund, how do I know what kind of mutual fund to invest in? Again, I can't give business or legal advice, but I can identify for you some of the resources that are out there and some of the products that are out there. For example, one very popular type of product with individual investors, particularly individual investors who have access to something like a 401k plan, is a target date or life cycle fund. That fund is invested with a goal towards the particular point when you will need to take money out of that investment, very often retirement date. So if you have a 401k plan at your work, you may have investment funds in there that are the 2050, the 2045, the 2040 funds, and those funds are targeted toward a retirement date around 2050, 2045, 2040. And as you might guess, the closer that target date approaches, the more conservative the holdings of that fund will tend to be. So just like we talked about earlier in the presentation, if the retirement date is very far off, the target date is very far off, that fund will probably assume more risk and invest in more risky asset classes than if the retirement date is fairly close and the fund is looking more at conserving as opposed to continuing to build on the funds within the fund. If you're new to investing, first and foremost, I really encourage you to go to investor.gov. There's a particular section that talks about basic principles of investing and gives a lot of resources for people who are new to investing, and then it builds on that into more sophisticated topics. So I would really start at investor.gov. Anything that you might want to know about investing probably is in there, including a glossary of terms. But once you've done that, think very carefully about where you get your investing information. A lot of social media information is, I would say, questionable at best, and at the very least requires a little further research and due diligence by you. Celebrity endorsements usually does not mean that celebrity has gone and done their own due diligence and figured out whether that investment is a good idea. Usually they are getting paid almost always to tout that investment, and they're going to get paid whether or not that investment pays off. So I wouldn't make my investing decisions based on celebrity endorsements or what's in social media, or even necessarily friends and family without doing your own research and going to investor.gov. Investing is not a get-rich-quick kind of scheme. Investing means putting money into well-thought-out investments for the long haul, for a longer term goal. It takes a lot of time. It takes a lot of consistency, and kind of slow and steady wins the race when it comes to investing for your retirement or long-term financial future. So let's talk particularly about technology and investing and some of the kind of benefits and pitfalls of the digital world. Alternative investments just is kind of a catch-all term that generally means anything outside of what we think of with conventional investing, bonds, stocks, money market funds, and that will include things like cryptocurrencies or ICOs, which are basically digital versions of IPOs or tokens, or hedge funds, which are frequently only available to really accredited investors, high net worth individuals. I think people are attracted to these, particularly in times of uncertainty, because they see a potential maybe for portfolio diversification or a hedge against inflation. But there are a lot of risks associated with alternative investments. In particular, they tend to have a lot less disclosure than your conventional investments. If you want to have your stock listed on the New York Stock Exchange and you're going to register your securities offering with the SEC, you are required by law to make a lot of disclosures about the financial health of your company, its history, its current operations, its plans for the future, with the idea that then potential investors will have access to that information, and then they can make their own investing decisions based on that information. And that's generally the way the regulatory scheme of the US stock market works. As long as you disclose information to the public and you disclose it fairly, appropriately, accurately, you're not holding back key information, you're not making misstatements, then investors have the information that they need to make their investing decisions, and we're not going to presume to make those decisions for them. Problems come in when people lie or withhold information, obviously, but if you're not investing in some kind of scheme or enterprise that's required to make those disclosures, then you probably have a lot less information available to you. Might be much harder to buy and sell that information, or buy and sell that investment. And sometimes there are very complex and significant fees associated with these alternative investments. So these are some pretty substantial risks associated with this investment category. Crypto assets, the regulatory scheme that applies to crypto assets, which I'll just use as kind of a catch-all phrase for any kind of digital related investment opportunity, is, shall we say, evolving. The legal definition of a security is basically anytime investors pool their money together in a common enterprise with the expectation that they are going to earn profits from that enterprise. But they are not actively involved in running the business of the enterprise. They're not running the company or the segment of the market that they have invested money in. They are passively sitting back and expecting that enterprise to generate profits in exchange for their investment. If something meets that definition, it is considered a security. So just because something isn't a stock or a bond doesn't mean it isn't a security, doesn't mean it isn't regulated by the SEC. And in fact, we have a unit in the SEC, the cyber unit within the Division of Enforcement, that specific mission is to investigate and prosecute potential fraud in this arena. And we've brought a great number of enforcement actions successfully. So if somebody tells you the SEC does not regulate crypto assets, that is not technically speaking true. But at the same time, this is still an evolving category. There may be specific regulations to be adopted in the future or statutes to be adopted in the future that might govern this space differently than they do now. And so that is in and of itself a risk that's associated with crypto assets. Again, there's a limited track record and they're highly speculative. So you just want to be very careful before you invest in this sector, and certainly extremely careful before you invested any significant amount of money in this sector. I would really encourage you to go to investor.gov. There's a particular part of that website that talks in depth about digital assets. And as I think we've all learned, if you've been watching this space at all this year, is that they are highly volatile. This chart on the screen, I believe, actually tracks Bitcoin, which at the oldest of the crypto assets is really only about a decade old, and it's been highly volatile over time. Up significantly during certain periods of time and down quite a bit in other periods of time. So quite a volatile and therefore risky asset class. In addition, this is an area that is open to a lot of potential manipulation, meaning people who have control of a significant amount of the asset may be acting behind the scenes in a way that is not beneficial to the individual investor, either by spreading rumors or engaging in fraudulent trading or disseminating fraudulent information. A pretty significant portion of this space is used by what I'll just call bad guys to engage in unlawful transactions like money laundering or terrorist financing or financing of drug transactions. And so, unfortunately, a pretty significant portion of this space is operated by people whose best interests, let's say, probably don't align with yours. And as we probably all read about in the media, it also requires a substantial amount of energy to engage in the underlying mining transactions, the computer transactions that create the value in this space. So again, there are a number of significant risks in this area, and I would really encourage you to go on investor.gov and learn about it as much as you can before making a decision about whether this is an appropriate asset class for you. You can lose all of your money when investing in risky assets, and if you engage in risky forms of trading, such as engaging in speculative trading or options, you can actually lose more than you invest. So you really want to be very careful when you think about how much of your portfolio you want to invest in risky classes or when using risky strategies. If you intend to buy and sell securities using an investing app, make sure that it's registered. It should be a registered investment firm. You can check on investor.gov. That landing page right at the very top of it has a search bar where you can put in your investing app, broker, dealer, or investment advisor that you're hoping to work with and find out if they're registered and if they have any kind of history that you would want to be aware of. Fees may seem low, but you want to make sure you understand what they are, because fees actually have the potential to eat pretty significantly into your returns. Even the difference of a fraction of a percentage, much less a full percentage point, can make a pretty significant impact into your return over time. Trying to time the market by picking the winners and losers, in other words, based on active trading, frequent active trading based on day-to-day news is actually quite difficult to do successfully. Generally speaking, people tend to hold on to losers too long and to sell winners too quickly. And studies have shown that missing even a couple a day of the best performing days over a given time period will result in negative returns. That is why for most individual investors, the strategy that works best for them is the kind of set it and forget it strategy that I talked about earlier in the presentation. Steady, consistent investing over time in a well-diversified and allocated investment portfolio. Something very frequently like an index fund where the fees tend to be much lower. Selling within a year generally results in higher taxes as well, so there are other financial reasons why you might want to think carefully about engaging in very active trading. And this is why, coming back full circle, mutual funds and ETFs, particularly index funds, very often make sense for individual investors. You get the instant diversification, makes it easier to allocate your assets across classes. Fees are generally lower, and it provides a simplified long-term investing strategy. You don't have to be constantly rethinking your investment strategy if you've planned with this long-term consistent investing strategy. So a little bit more digging deeper into planning for retirement. Again, if you've got a 401k or similar plan at your employer, I would think very strongly about potentially participating in it, because very often it will give you a pretty diverse choice of investment funds, and hopefully you have an employer who matches contributions. That's basically free money on the table, and you don't want to leave that on the table if the employer is offering it to you. That can go into your retirement account. There are limits. They do get increased at the age of 50. The same holds for individual retirement accounts. If you would want to open on your own an individual retirement account, again, you can usually invest in a pretty wide range of investment options, but there are limits on annual contributions. You maybe have heard the term a Roth IRA or a traditional IRA. Both of them have, there are benefits to both. It really depends on what works best for you in your particular situation. A traditional IRA, the money goes in before taxes. So this lowers your taxable income and the money grows tax-free, but it will be taxed when you withdraw it upon your retirement. A Roth IRA, the money goes in after it's been taxed. The money, again, is going to grow tax-free, and it will be tax-free when you withdraw it, meaning you won't have to pay income tax on that when you take it out on your retirement. So a lot of people invest in a combination of them. Really, part of this question is, do you think your tax bracket is going to be higher now or when you retire? And that's part of the questions that you probably want to ask yourself if you're considering investing in a traditional or a Roth IRA. Basic tips for your retirement account, as we've talked about: don't delay, take advantage of employer matching, contribute consistently, and make sure you pay attention to fees. In some versions of this presentation, not in this one, unfortunately, there is a slide that shows the impact that fees can have on your retirement account. And again, even the difference of a quarter or a half percentage point can have a pretty big impact. How are you going to do that? One really helpful tool that's out there on the internet is at FINRA's website. FINRA is the self-regulating organization that oversees broker-dealers, and FINRA is in turn regulated by the SEC, as well as the broker-dealers who are also regulated by the SEC. If you go to FINRA's website, finra.org, there's a tool there called the Fund Analyzer. So if you've done some research and you've identified maybe 3 or 4 different mutual funds you're thinking of investing in, you can put them in this Fund Analyzer and it will compare them side by side, including showing the costs of owning those funds, which is a very important factor that I think sometimes is overlooked when people are considering investing in particular funds. Again, just to reiterate, slow and steady in many ways is the way the race is won for individual investors. Individuals who've invested in their 401k and come out the other side having $1 million or more in their 401k, have several things in common. They usually start participating in employee-sponsored retirement plans at the very beginning of their career. They take advantage of those employer matches. So if your employer matches, if you donate 2% and your employer matches 2%, if you donate 3% and your employer matches up to 3%, many employers will match up to, say, 5%. If you are able to invest as much as 5% into your 401k and your employer will match up to that 5%, do everything you possibly can to meet that 5%. If you are investing at 2%, you're leaving an extra 3% of free money that your employer would match on the table. So try to take advantage of those employer matches to the greatest extent possible. Contribute consistently whether the markets are up or down so that you can get the benefit of that time horizon and own those securities when the market makes its inevitable turn up, and be able to be comfortable when the market makes its inevitable turn down, that you will be in the best place you possibly can when the market turns around. Contribute through your entire career and use an investment strategy that's appropriate for your time horizon. This is what 401k millionaires have in common, and you too can be this person if you start with these basic investing principles in mind at the beginning of your investing career. If you switch jobs and you have a 401k, very often you can keep your former employer plan. But if not, and even if so, you may want to roll it into a new employer's plan or your own self-directed IRA. So let's talk very quickly about some tips to avoid fraud so that I can leave time for questions. Essentially, one of the things I like to make sure people are aware of is just how very prevalent fraud is in this country. If you have been telecommuting over the course of the pandemic, you probably have realized just how very many telemarketing calls you avoided by being in the office, and that you're now receiving at home. That's just kind of the tip of the iceberg. More than 8 in 10 of us will be solicited for potentially fraudulent offers. I'm not sure if this particular survey meant over the course of the year or over the course of a lifetime. I would bet that every single one of us will be solicited for a potentially fraudulent offer at some point in our life. But more troubling is that roughly 15% of us will end up actually investing in something that is potentially fraudulent, and more than 10% of us will actually end up losing significant funds to fraudulent offers. So unfortunately, fraud is quite prevalent, not just in general telemarketers, but also in the investing world. The red flags of fraud are really kind of what you might think they would be, but it's very easy to lose sight of them in the pressure of a really good salesperson, which I guarantee you, having sat across the table at depositions and in court from fraudsters, they are very charming, persuasive people. Frequently, they will pressure you to buy quickly. They will, as I said earlier in the presentation, promise you that you will get high returns with little or no risk. Very often, they will use some kind of free meal scheme, maybe a luncheon seminar, free investment advice, free lunch, no investment required, and use kind of that shared sense of community to put on the soft sell and maybe ultimately the hard sell to invest in their questionable schemes. You'll feel like you want to reciprocate in exchange for the niceness of the free meal or the free investment advice. But of course, a free lunch is really a pretty small expense compared to your financial future. So no matter what you do, you want to check the financial professional's background before you invest with someone. You want to ask questions. You want to research every single investment opportunity thoroughly, and you can do that through investor.gov. So whether you go on investor.gov from your phone or from your laptop, the landing page, the very first thing it has on it is a search screen where you can look up the background of your investing professional, your broker-dealer, the broker-dealer's company. And if they are not within that database, then they probably are not licensed or registered to give investment advice or buy and sell securities. If they are in there, the database will have important disclosures and their employment history and really useful information for making a good decision. Likewise, you want to investigate what you are investing in. So the actual investment product, the stock or the fund. And if stocks are bought and sold in the public market in the United States, they should be registered with the SEC. Scams very frequently involve unregistered companies. So you can go to sec.gov, and there is a search page for what we call EDGAR. That's our database of all the companies whose filings are made with the SEC. So if I wanted to invest in, say, Exxon, I could go and put Exxon in there, and up would pull that company and the disclosures that it's made to the public. It's regular financial reporting. If my neighbor next door is trying to get me to invest in XYZ company, I want to put that company's name in this database search tool as well. And if I don't see it in there, that is a huge red flag, because then you want to start asking some questions. If you're offering an investment, why is that investment offering not registered with the SEC? And very often, as I say, scams involve unregistered companies. So I would be very hesitant to invest in an unregistered company without doing a great deal more due diligence. Be careful how you pay. Legitimate brokers are not going to ask you to pay for securities with a credit card. And then finally, going back to investor.gov, here you can see the landing page, again, right in the middle, the search tool. Then if you look at the lower right-hand side, there is the beginning of a field that you can see when you scroll down the website that says Get Help. If you have an investing question, just general investing question, or if you are concerned and want to report a tip about a potential scam that either you might have participated in or someone you know might have participated in, this is where you can do it on the website. Enter in your question or information about the potential scam that you've become aware of, and that information gets reviewed almost immediately by SEC staff. Again, there are a large number of financial planning tools on investor.gov, really helpful, including tools like the required minimum distribution calculator and the compound interest and savings goals calculators, which get used every day. And I really encourage you to check them out. We also have a lot of investor alerts and bulletins that detail kind of the latest scams that you want to be aware of, and have a lot of general investing information and knowledge that's really helpful. And then finally, I'll end with a slide which has contact information for the SEC, and open it up to any questions that anyone may have.
Thank you so much, Carol, for a great presentation. Okay, let's get to the questions. We have one question. I'm sorry about that. Should investment strategies change when the market is volatile? Does that make a difference?
Yeah, so that's a good question. And again, I of course can't give particular investing or legal advice. And this is something that I think is on the top of everybody's mind, given how the market has performed and the economy has performed. Generally, this year has been relatively volatile year. Generally speaking, I would say, again, this is a question that I can't answer for you, but if you have taken some of these general investing principles in mind and begun investing at the beginning of your career consistently over time, the volatility of the market, while it still might give you some concern, probably will give you less concern, because you have that set it and forget it strategy. Now, what your particular situation is, if you are working with an investment professional, an investment advisor, you might want to go to them in situations of volatility and get their particularized investment advice. But the idea of investing over a lifetime, consistently, regularly, in something that takes account of your investment horizon, that takes account of your risk tolerance, that's diversified and allocated against investment classes, is that you don't have to worry as much when the market inevitably goes through some changes, whether it turns to up or down, or is just volatile. You can take some comfort in knowing that you've planned wisely for your future.
Thank you so much. Do most individual investors work with brokers or investment advisors?
So the answer is both and neither. So if you don't know, the difference between a broker and an investment advisor is a broker typically is paid on commission and will execute particular trades for you. Either you've told your broker you have authority to make certain kinds of trades on my behalf without asking me, or you've got to ask me each and every time you make a trade, or I'll tell you when I want to make a trade. That's what a broker does, and they usually get compensated by commission. An investment advisor provides more kind of umbrella investing advice, and usually gets paid by assets under management. So you might invest in a particular fund, and that fund might be advised by an investment advisor who gets as compensation a percentage of the assets within that fund. It used to be you were either a broker or you were an investment advisor, but now you can be duly registered, and a lot of financial professionals are both brokers and investment advisors. Either way, if they are licensed or registered, they should be in that database that I showed you. Some people don't work with either and make their own investing decisions, whether that means investing in your 401k or a self-directed IRA. Again, you're still going to want to do that research that we talked about.
Thank you, Carol. Okay, we have another question that came in. What's the best way to find a financial professional who is a fiduciary?
So again, I would go to investor.gov and look at that website and look specifically research broker dealers and investment advisors and familiarize yourself with those categories of financial professionals. Now, there are financial professionals who are not broker dealers, who are not investment advisors. Again, if somebody is giving you advice on how to invest in securities, they probably should be registered as an investment advisor and or broker dealer. So the very first thing I would do is do some general research on investor.gov and just familiarize yourself with the different kinds of financial professionals out there. It's fine to take recommendations from friends or family members who you trust, who maybe are working with financial professionals, but then you do want to do your own research on those people. Once you have identified maybe 4 or 5 people that you might be interested in working with, then you should reach out to those people and do an interview, just like someone might conduct a job interview, because that's really what you're doing, is hiring them to do a job for you. And there on the investor.gov website, there are suggested questions that you might want to think about when you talk to any potential fiduciary who would work for you, or any financial professional who would work for you. And you can just ask them flat out, will you be a fiduciary? Will you be serving as a fiduciary? What are your fees? How long have you worked in this area? What kind of investors do you typically work with? And a number of different sorts of questions that would be spelled out, at least some suggested ones on investor.gov.
Thank you, Carol. Okay, we're really running out of time. Les Otts, thanks you for a very informative presentation.
Yeah.
And everyone else, I really do have to end the program here because we are almost at time. Thank you, everyone, for chiming in, and thank you, Carol, for a great presentation. I wanted to remind everyone, if anyone missed any of this presentation, it will be available on LAPL's YouTube channel shortly. The link for that is www.youtube.com/Los Angeles Library. And please join us again. We have a few more Financial Planning Month programs coming up on topics like savings and estate planning. And we have a Financial Planning Day this Saturday, October 15th, where you'll be able to make a one-on-one telephone consultation with a certified financial planner. So for more information on all of our programs, please visit our Financial Planning Month webpage. That's www.lapl.org/financial planning. Thank you all again and have a great rest of your day. Bye, everyone. Thank you. Bye-bye.
Thank you.